runaway winners, and the balanced portfolio. On today's episode, we're going to talk about what to do when one of your investments just shoots the moon, maybe. And in light of that, you started out in a very diversified, balanced manner, and now suddenly something you own is your entire net worth, or is most of your net worth. Are there any decisions that need to be made? We invited Brian Feroldi to join us on the show today to discuss exactly that. Welcome to the ultimate crowdsourced personal finance show. This is Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys, very excited to talk about this wonderful situation that maybe there's a lot of you in the audience that have experienced. A stock or maybe a crypto investment has blown up. It was a very, very tiny piece of what you held. And, it's frankly shot the moon. To help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, last time we had Brian on, we talked about how he constructed his portfolio in terms of putting new money in. And it was really enlightening and illuminating for me to see how Brian thought about this. But as you said, Jonathan, we've seen stocks, Tesla is certainly one of them. We've seen stocks go crazy. And people who had a plan, right, best laid plans, all of a sudden, they're sitting on a huge percentage with maybe one or two stocks. And what do you do now? How do you think through that? And obviously, Brian is the first person we thought of for how to think through this type of complex issue. So, Brian, with that, welcome back for the many time here. I joked last time, the manyth time to Choose FI. So, always
Brad,
good to have you, buddy.
Your jokes are so good, man.
Oh, yeah.
I'm laughing on the inside, Brad, I promise.
Brian didn't even give you a courtesy laugh, dude. It was cold.
I'm not even laughing, so don't worry.
Thank you, guys. Great to be back.
All right, Brian. So I'm looking at this chart that you sent my way, and I believe it's actually from Y Charts, but it was taking a look at basically Tesla topping a $1 trillion market cap. And when you put that in perspective, I mean, you could look at Tesla, you could look at Bitcoin, Ethereum. Bitcoin over the last year up 100%, Ethereum up 500%, Tesla up 70% for the year. But when you go to 3 years, it's been a 1,000% return. It's been a 10-bagger. And I know personally many individuals that had, a decent, a significant chunk of money, but relatively small piece of their portfolio that was in one of these cryptos or stocks. And suddenly when they look at their net worth, 60, 70, 80% of their net worth is now in one of these. And it wasn't a situation, it's a situation you would hope for, but if you have kind of this whole mindset of the balanced portfolio, you've traded in the balanced portfolio for the runaway winner. And I'm just curious to prompt that as a dialogue. Is there any action that needs to be taken? Do you just let winners win?
Yeah, it's the best quote unquote problem that there is out there, right? Oh no, something I bought is up so much that it now represents a huge amount of my net worth. So personally, I've been an investor in Tesla for almost 10 years now, and I would have never guessed 10 years ago about what was about to happen to Tesla stock. But Tesla today is actually become my number one holding by a wide margin. And a big reason for that is because over the last 2 years, 3 years, the stock has just gone up and up and up. It's just gone parabolic. And to your point, the company is currently trading at over $1.1 trillion. That's bigger than Facebook. And it's now actually the fifth largest company in the United States. And I'm generally the type of person that likes to add to winners and let winners run. However, I must admit that even I am now considering taking some money off the table with a company like Tesla, specifically for risk management purposes.
So, Brian, you're so measured in how you think through your portfolio construction. Like, at what point do you start having those thoughts of, okay, there is some risk here? Is there a percentage? Is it, I know it when I see it type thing? Talk me through like how that even starts.
So this number is going to be different for every investor. I mean, I know some investors that would be perfectly comfortable having 60, 70, or 80% of their net worth in one stock. Like that's just the risk level that they're built for handle. I can tell you that is not me. I would not do well as an investor if I had that much of my personal net worth tied to one stock or asset, especially if that asset class was super volatile and risky, such as Tesla or Bitcoin or Ethereum or something along those lines. So in general, with things like this, I'm a huge fan of doing what I always do, sitting down and asking myself, what is the most amount of capital that I am willing to have at risk in any one stock, any one asset, everything. The number that I have come up with in my head is between 10 and 15%. That I just kind of pulled out of a hat to be like, if like one stock became 10% of my portfolio, I would have to really ask myself hard, do I want to have this much exposure to one company? And it depends on the nature of the company, to be honest. Some companies are so big, so stable, so predictable that I would be comfortable having that much money in there. Like a company like Amazon, I would be perfectly fine having in there. Tesla now has become my largest position, and that is a different scenario. While I'm very, very bullish on the long-term viability of Tesla, the company, the future of the company is extremely wide, right? It's very unpredictable. If it stays on the trajectory that it could be on, I could easily see Tesla having 10 or even 50x the revenue that it has now 10, 20 years from now. Conversely, I could also see Tesla unwinding and something could go wrong if Elon Musk had a nervous breakdown or something or gets spread too thin. I could also see the value of Tesla being much lower in the future. So it's a situation where I'm not as confident in the future of the company that I would want to risk a significant amount of my net worth on it. So a company like Tesla, I would probably cap that at something like 10% of my portfolio. A company like Amazon, I would probably cap that at something like 15%. But these are arbitrary numbers that I'm making up. I think it's still worth the exercise of going through that process and asking yourself what number would disrupt your sleep and really focusing on that.
I think it's really interesting here because the three that we just picked out have been incredibly volatile and have had massive growth over, a relatively short period of time. But we're talking about two different markets with different fundamentals. And I know you're obviously much more familiar with stock market fundamentals than you are if you're talking about crypto, as we were talking about Bitcoin and Ethereum. But like with Tesla, as part of this calculus, I would imagine you are still going back to the checklist that we've referenced, many, many times. So people that are interested, Brian has shared his checklist with us. You can access it at choosify.com/Brian. All the information is there. And it's a checklist that he reviews every single month to see, how do I feel about this company? And it helps you, Brian, and you can maybe reinform this a little bit, but it helps you make a decision like, is this stock expensive compared to what it was before? Is it more attractive or less attractive than it was the month before? And, you're very happy when you have a position that has gone dramatically up, but there's the two aspects. Do I want to buy more at this price? And then also now, probably for the first time, wow, look how much it's appreciated. Do I want to unwind any of this? And that's kind of different than the conversation we had before, which is really just about when do you want to add to your position?
Yeah, so as we've talked about on the show previously, I created a checklist for myself that I use when I'm evaluating what stocks I might be interested in purchasing in the future. So I can take any essentially individual company, and after doing a few hours of research, I go through my checklist top to bottom, and it's essentially making sure that I check the things that I want to check to figure out if a company could be worth investing in the future. So I look at the company's financials. I look at the company's returns on capital. I make a measurement about the company's competitive advantage and the direction of the competitive advantage. I look at the company's long-term revenue growth potential, the quality of the management team, the business model, the stock performance, and any risks that I can come up with. And at the end of this process, I get kind of a score, which tells me how much of a fit any given company is for potentially enter my portfolio. So that's step one. It's basically a business quality checklist. Step two beyond that is, should I buy this stock now or at any given time. And that's a different discussion that really is based around the current valuation of the company versus the long-term potential of the business. Let me just break that really simply. Let's say I go through this checklist and I find a company that's trading for $5 billion. The entire company is worth $5 billion. And I say to myself, if this company is successful, I could literally see it being a $50 billion company someday. So the return potential on this company is 10x if I'm right and if the company executes. Well, that's interesting to me. I could literally make 10 times my money on that company. Conversely, if I look at a company and it's a high quality company and that company is trading at $200 billion, and I say, well, if this really works out, could this be a $400 billion company one day? Well, that, if I'm right, is a 2x return, right? And then I have to judge, well, what's the risk or the chances of that happening? So step one is always about quality of the company, and that's kind of like likelihood of me being right. Step two considers the valuation of the company and how much I can make if I'm right and how much I can lose if I'm wrong and the odds. And it's really about marrying those two principles that kind of informs what stocks I buy or add to my portfolio, which stocks I buy more of, and which companies have the most long-term potential.
So I'm curious, kind of playing off Jonathan's question, the interplay here ultimately between what you would normally do. So let's talk specifically about Tesla, right? I'm going to make up numbers, but let's just bear with me here. So the interplay between your normal strategy, okay? So it's already past the checklist. Obviously, you are an owner of Tesla stock. And then we're talking about reaching this 10% threshold of your net worth where you're beginning to become relatively uncomfortable with this. But let's say that going back to you're looking at this company and you're saying, okay, it still meets all of my requirements. I still feel great about it. I'm still fine with the price to earnings ratio. And that actually might be an interesting question for you, is the interplay of that, the PE ratio, because maybe this stock in particular has gone up because of sentiment, not because of underlying fundamentals. So, talk me through that portion. Would I normally continue holding Tesla or potentially buying more, but then it's running up against this 10%? Like, how do you deal with that, right? Because those are conflicting things of, hey, I normally, if this was 5% of my net worth, I would keep buying or I would keep holding versus it's hit this wall. Now what?
Yeah, so that's kind of an interesting story about what's happened with Tesla over the last 2 years. If you rewind the clock to 2019, Tesla was unprofitable. It was losing money, and the market was only valuing the entire company at about 2 to 3 times sales, meaning for every dollar in sales that Tesla was generating by selling its cars and products, the market value of the market was basically saying, okay, the company is worth 2 times that sales numbers. I say sales because the company didn't have earnings. So there wasn't a price to earnings ratio to look at. If you fast forward to today, the company, financially speaking, is on a completely different playing field than it was 2 years ago. The company is now highly profitable. The company is producing free cash flow. The company's margins, which are like the percentages that it makes on the sale of any car, have gone up. And the business itself has gotten so much stronger than it was 2 years ago. Now, that optimism and that strength is more than reflected in the company's valuation. So again, 2 years ago, the market was paying $2 for every $1 in Tesla sales. The market is currently paying $28 for every $1 in Tesla's sales. And that shows you why the stock has gone up so much, is because 2 years ago, the market was paying very little for Tesla sales. Today, they're paying much more. Now, Tesla also now has a price to earnings ratio because it is actually making earnings. And looking at the price to earnings ratio of the company today, it's trading at about 380 times trailing earnings, looking backwards a year. And it's trading at about 143 times forward earnings, meaning is what the market expects the company to earn over the next year. Those are high numbers that suggest that there's a lot of optimism baked into Tesla's share price today, which suggests that the market is expecting this company to remain in hyper growth mode for many years to come. I personally believe that Tesla will remain in hypergrowth for many years to come. The question that I'm struggling with is, do I want to bet 10% of my net worth at the current valuation that Tesla can achieve that numbers?
Brian, and I just don't have the information. I'm just curious if you have any thoughts on this. How much of the market price is driven by FOMO and people like me who don't look at price earnings ratios and don't want to miss the ride, hopping in, not really even thinking about how expensive it is, and the fact that they didn't even have a price to earnings ratio, and the fact that they weren't profitable up until XYZ, like hopping in on the train, on the ride, versus people that are looking at something that is like 3 or 4 times more expensive than Microsoft or Amazon. Maybe I don't even know those numbers, but probably much more expensive on a price to earnings basis than Microsoft or Amazon. And them also saying, I think this is justified because they're about to roll out this, therefore I'm going to double down and buy more here. I think that's just kind of like an interesting thought process to calculate. Is it truly FOMO sentiment, or is it this price to earnings ratio is justified because this is on the horizon? And you're the perfect person to answer that.
Well, the question there is, what happens to any given stock in the short term is always related to sentiment. It's always related to what people are expecting to happen to both the business in the long term and the price in the short term. So there's so many factors that determine what any given stock trades at today. And that's especially true over the last 2 years when we've seen things like GameStop, for example, become a meme stock and go from $3 a share to $400 a share for essentially no reason at all, other than it became popular on Reddit. And that's very true with Tesla stock. Tesla is a very polarizing company. There are people that are extremely passionate about it and bullish on the company. There are people that are extremely bearish on it and think that the company is essentially a Ponzi scheme. And that leads the stock price to do wild things in the short term. But in general, when a stock price is up this much in this short of a period of time, that's because of there's been a massive shift in sentiment. 2 years ago, people were thinking that's the end, Tesla is going down. Today, they're thinking Tesla can do no wrong and the price is going to continue going up. But that's always the case with any given stock. It's just that Tesla is a more extreme example of that in the short term. So I always focus on the fundamentals of a company and where I think the business can be in 5 and 10 years. And I'm fairly confident that 5 and 10 years from now, Tesla, the business, Tesla revenue, Tesla profits will be remarkably higher than they are today. Whether or not that translates into gains for shareholders is another question that is going to be dependent on the valuation that Tesla garners in 5 and 10 years time. I'm betting that the price will go up from where it is today, but my confidence level is certainly lower today since it's gone up so much in the past than it was 2 years ago when the valuation of this company was very, very low.
Right. And obviously, this is not investing advice. This is your own life, right? This is where you are now. And this is what's so fascinating, right? So now you still feel this is a company that you want to own significant amounts of, but you're at that 10% or you're getting pretty close. Talk me through what actually happens now. So you hit that 10% plus or minus, and you need to start making, or I'm assuming you need to start making changes. Do you not put additional money in? Do you start selling? Like, talk me through the thought process as it gets close to that date and like what you're planning on actually implementing.
So this is still a work in progress for me, but I could very much see myself selling a few percent of my Tesla holdings. So again, let's say it was 10%. It's getting close to that number for me. I would probably take that down to say 9% or 8% or some number that I'm comfortable with, depending on prices and when I actually do this and all that kind of stuff. And then I would take that, those gains. I would, of course, have to pay taxes on them. Boo to that. But I would then reinvest them into companies that I think could become the next Tesla of sorts. So I would be on the hunt for companies that I think have long-term growth trajectories that could take whatever capital I put into them and grow them significantly over time. That's just my general strategy. I take my winners, the ones that have done kind of the best after I think their growth phase is slowing, and I redeploy them into kind of like the next phase of growers. But I think this is a problem that some people are just facing with their lives right now, given what's happened to asset prices over the last couple of years. And one other thing that I want to throw out there, if you're listening to this and you have just through appreciation of Bitcoin, for example, if Bitcoin is now 50% of your net worth or something like that, the percentages do matter, but there's also something else that you need to take into account. And that is the future value of your contributions. So let's just throw some numbers out there. Pretend for a second that your net worth was $50,000 and 25,000 of that was in Bitcoin or Tesla or whatever. Like that has gone up so much that it's your biggest winner. Well, at that level of net worth, you also have to consider how much money am I contributing to my investments on any given month. Let's say you're following 5 principles and you're contributing $1,000 a month to your portfolio. Well, that's $12,000 per year. In proportion to that $50,000 of your net worth, that's a decent amount of money that you can redeploy into other assets. You can buy other things, and that will naturally lower your percentage of that any individual holdings. Conversely, if you're on the other end of the pool, and let's say you are lucky enough to have $1 million and $500,000 of that is in Bitcoin or Tesla or whatever, that's a different equation, because that $1,000 that you're adding to your portfolio any month is essentially 1% of the value that you're impacting your net worth in any given year. So you do also have to keep that in mind. In general, the higher the percentage that your future contributions are, I think the more risk tolerant you should be with the percentages, and the lower the impact those future contributions are, the more worried about this kind of thing you should be. So that's just one more nuance I wanted to throw out there.
No, I love that, because you're actually giving, as Brad was saying, there's 2 different ways to rebalance. You can rebalance by selling. You can also rebalance by thinking about what do you want to do with future contributions. So now you're at that fork of the road and you make the decision around which approach you take by really looking at, well, will it have an impact? So as this is relatively early on in your investing journey, it's a smaller overall piece of the pie generally. Why incur the taxable event if you don't have to? If you decide to incur the taxable event, then you probably want to be aware of where the capital gains brackets are and just familiarize yourselves with those rules so that you can do that in as tax optimized a way as possible. And then, Brian, I would think the other variable that you want to work into all this is, how do you handle volatility? Just generally, how do you handle volatility? And what's interesting, and I'd love your feedback on this, is I have some money in crypto world, and I'll be honest, personally, I don't feel like I'm as susceptible to volatility in crypto, just because it's almost like, yeah, I mean, it's gambling in Vegas. Like, it goes up 200, 3,000, like it's Squid Games, right? It goes up 28,000% and is down to $2 the next day. It's almost like, well, yeah, that's what you signed up for when you came here. But like, if I have something invested in, the regular market and it goes down 5 or 10%, I'm like, whoa, what's going on? That's literally the difference between 12 a.m. and 6 a.m. over in, crypto blockchain world. So I guess that being said, the larger question is, Brian, let's say that your net worth because of your Tesla holdings is $1 million, and you make the decide, I'm going to ride or die on Tesla. And, a week later, because of bad news after bad news after bad news, it's down to, your net worth's down to 700,000, your net worth's down to 500,000. The what could have been, is that going to destroy you? Like, how much does the sleep component come into taking risk off the table?
I think it's a huge factor. And this just in generally gets back to your personal views on money and what you can handle as an investor. If you're going to put money into the stock market or cryptocurrencies or any asset that is subject to short-term volatility, you're going to get hurt. Like, you're going to feel volatility firsthand, just like I have. I've seen my portfolio peak to trough drop over 60% in 2008, because that's what the entire market was doing. It was going down. And if you're going to invest in the stock market, you have to, 1, know that that is a possible thing that can happen. And 2, you have to be ready, willing, and able to deal with that volatility. So you need a plan in place to deal with that. In 2020, when COVID was really starting to ramp up, peak to trough, I think the S&P 500 or even the total stock market index dropped like 35%, something along those lines, in about a month. Talk about a scary time where the world was going upside down. People were all of a sudden having to deal with masks, and you're worried. Everyone's worried. At the same time, you had to deal with your portfolio getting punched in the face and seeing a huge drawdown. So the way that I deal with that volatility is, first, just studying stock market history and just embracing how common and normal volatility is. If you look back historically, the stock market falls about 10% once every year. It falls about 20% once every 4 years. It falls about 30% about once a decade. And it falls 50% about 2 to 3 times per lifetime. That's just the odds. Those are just the odds that you're working in. So whenever I see the stock market falling, I always remind myself, this is normal. This is normal. In fact, this is the price that we as investors have to pay in order to earn the returns that are afforded you in the stock market. The price of high returns that you get from stocks is perpetual short-term uncertainty and volatility.
Hey, this is Andrew from the Choose FI team. Hope you're enjoying the interview. We're going to get right back to it right after these quick messages.
We were having a conversation earlier and we were talking about why the stock market goes up, but in general, like how often they go up. And we were astonished that when you hold stocks, and in this case, we were looking at large cap index funds, S&P 500, when you hold stocks for a period of 20 years, you have made money in real returns. So inflation adjusted real returns, not 90% of the time, 92% of the time, on a rolling 20-year period, you have made money, real returns, inflation adjusted 100% of the time. So you could have been the worst, unluckiest investor ever. You could have dropped $1 million, all of your net worth, that day right before the stock market crashed in 1929, that horrible period of time. 20 years later, you would have made real money and inflation adjusted returns. We've had inflationary periods in the past. We have inflation now. You would have made money over a 20-year period if you bought it on the worst day and then carried 20 years forward. You would have made money, real returns every single time. It's a real thing. Now, the reason I say that is we set this conversation up talking about 3 different funds, I guess, or investments, potential investments. We talked about Bitcoin, Ethereum, Tesla. That conversation was largely around just the whole stock market, large cap index. Now we're talking about individual companies. And as you start moving your way down, you're going for, all right, you have the whole index fund, the whole market, all stocks, 100%, of the time over a 20-year period, you made a real return on your money. And now you're talking about Tesla and you're like, well, I don't know. We'll see in 20 years. Probably I've already made a ton of money now, but here are the fundamentals that I'm looking at, and then it's this balance between the fundamentals and the sentiment, and the sentiment's going gangbusters. And then you move over to blockchain and Ethereum. I'm sure there are people that would want to tell us about the fundamentals. And I'm not saying that your point is wrong, but I would say as you move from Tesla to blockchain and Ethereum, what you're seeing is almost entirely sentiment, and has been sentiment the entire time. And the volatility that is associated with that, like when you look at just crypto world in general, if you pick a crypto, any crypto, will you make money 100% of the time if you hold it over a 20-year period? We're talking about increased level of risk. And what I'm trying to get at in a very long-winded way, and I hope people slowly appreciate that, is that how does this involve you needing to take profit? You putting a higher priority on taking profit. There's a possibility for insane returns here, but returns today may not be returns a week from now, returns 2 weeks from now. So having a rule-based structure that you feel confident in, I think has to be a critical piece of your investing strategy as you start talking to more sentiment-driven investments.
Yeah, if you're going to invest in individual stocks or cryptocurrencies, right? All the data that we have, all the data that I look at is basically on the stock market looking at 100 years. We have none of that data for cryptocurrency. Cryptocurrencies were essentially invented just over a decade ago. So they're so new. There's no historic way to look at the data. But to your point, Jonathan, I was absolutely blown away, just like you were, when I learned that over a 20-year period, over a rolling 20-year period, there has never been a time in U.S. stock market history where an investor bought the S&P 500, held for 20 years, and lost money in real terms. They always made a positive return 100% of the time. And that just tells me that the stock market is not risky. What's risky is when you buy stocks and don't hold them for the appropriate period of time.
Right. And that's an entire thought process on what we're doing here. So many people here investing in the stock market and think gambling, versus what we're talking about is long-term wealth creation. And I'd love to hear just kind of your high-level thoughts on maybe why people think it's gambling, and contrast that with your thought process on investing in the stock market.
Well, if you look at the exposure that the average person has to the stock market, what is it? They see prices in the news, or maybe prices on their iPhone. And those prices are random. Some days they're up, some days they're down. The only time that the world really pays attention to the stock market en masse is when prices are rapidly falling, right? When something is going wrong. So if that is the lens that you look at the stock market through, of course your assumption is going to be it's a gambling machine, right? Some days it's up, some days it's down. The price movements just seem random. And the truth is, over the short term, stock price movements are random. On any given day, your odds of making money in the market are about 51% positive, 49% negative. Like it's very much a coin flip. What's going to happen to stocks over a day? However, when you invest for long periods of time, the market goes from, as Ben Graham famously said, the market goes from a voting machine where sentiment rules to a weighing machine where earnings rule. And if you're investing in companies or the S&P 500 or the stock market broadly, for long periods of time, you are betting that the earnings power of those companies that you own is going to be higher 5 years from now, 10 years from now, and 20 years from now than it is today. And historically speaking, that's been a very, very dependable bet.
Hey, Brian, I wanted to go back to two things we talked about a handful of minutes ago. So I guess first was this example, right? We're talking about this person who has 50% of their net worth in Bitcoin, which, obviously I don't think any of the three of us would recommend, but that's beside the point. So you were saying somebody who had a $50,000 portfolio, right? So they had $25,000 in Bitcoin versus someone with $1 million portfolio who had, therefore 500,000 in Bitcoin. And you were saying, okay, they follow the 5 principles, they have future contributions. And this is the interesting thing, the impact of those future contributions on your portfolio construction and how you mechanically go about getting to a percentage you want, right? So I ran the simple numbers. So if we're talking about $12,000 additional that these people are going to contribute to their portfolio, presumably in something else, right? They're trying to rebalance down from this percentage. So somebody who started at 50,000, right? So they had 25K of Bitcoin. So at 50%, now they have 25K of Bitcoin, again, hypothetically, out of 62,000. And that goes from 50% down to 40.3%. So, okay, that seems like a viable strategy. Potentially, you don't have to sell, you don't have to incur capital gains taxes, et cetera, versus that person with $1 million portfolio, right? So 500K out of $1,012,000 took them from 50% only down to 49.4%, right? So clearly that strategy is not working quite as well. So I guess in that case, would you advocate that person start thinking about selling, like kind of how you're thinking through the Tesla construction of your portfolio?
I would advocate that person with that $1 million portfolio that has 500,000 in Bitcoin to at least ask themselves the question. And really, this kind of stuff always just gets back to personal comfort levels with individual risk. If you're the type of person, if I know some people that would lose sleep. If they had $1 million portfolio, they would lose sleep if they had $50,000 in a stock. Like that's 5% of their net worth, but they would not. They would be so worried about the next earnings report or that stock's going down. And for that person, selling to get them down to a point where they can sleep at night makes complete sense to me. Conversely, I know people that would be completely comfortable having 50%, 60%, 70% of their net worth in Bitcoin. Like they're just completely fine with that. And for them, I would probably advocate to them, well, maybe we should pull it back a little bit, but it always depends on the individual. And I'm not advocating for any particular strategy. I can tell you what works for me. For me personally, 10% to 15% is where I personally start to get out of whack. But no matter what, I still think the process of going through and writing this stuff down and thinking through what's going to happen or just making rules for yourself is so valuable. And importantly, doing that ahead of time. Making those rules for yourself before you get into the situation. Because if you're making decisions while you're also looking at the price of Bitcoin and you see your net worth going up and down by the second, it's easy to make an emotional mistake when you have that kind of distraction going on. So just in general with everything about investing, I'm a big fan of writing that investor policy statement for yourself, creating the rules when you're calm and when you're thinking slowly. And then when you're actually implementing them, follow the rules.
Yeah, there's some aspect to that I think is really important. It's not that you're telling someone, if you have 70% of your portfolio in Bitcoin just to sell it, get out, sell it. No, that's not the point. It's just historically speaking, if you look back over the last couple of years, 3 years, 4 years, if you have just ignored the noise and held on, you have been rewarded really, really well for doing that over this period of 2 to 3 years. But I think all of us, whether we're talking about crypto or the stock market, we are not investing as a form of charity or goodwill. That's not why we're doing this. It's very easy to get sucked into the cause, the belief, whatever. As a Tesla holder, you can buy the dream, you can buy the vision, like all that. But ultimately, you're not investing your money as a form of charity or as a goodwill. You're doing it with an expectation of return. Where all of us are taking the time to listen to a podcast, taking the time to do our research with the hopes that we can create a scenario where our money will make money for us. So now going back to this short-term lens, we had, $1,000 in Bitcoin. It's now $20,000 or some, Ethereum, it's whatever, Tesla, we've had a 10 bagger, we've had a 5 bagger. And our experience over a relatively short period of time is I can 5X. So, okay. The next thing is, well, if it just goes down, I'll just buy more. I will buy the dip and I will be rewarded for that again. Okay. That's one thought exercise and that could definitely map out that way. But hypothetically, what if your choice, whatever you're highly concentrated in, your $1 million investment now, your runaway investment, your moonshot, it goes down to 200,000 and it stays there. It goes down to 20,000 and stays there. Are you going to hate yourself looking back? Are you going to regret that you could have thought through these kind of crazy scenarios now? You can think through it now and you write it out. Well, if the market had gone down 80, 90%, would I have wished, or will I hold it 10 years? It's ride or die. I don't care if this investment goes to zero. That's how much I believe it. It is either it moonshots again, it does another 10 to 20X again, or I will ride it into the grave. And I'm good with that because I will be here at that implosion, at that bomb. And I will say, well, it was a fun ride. Man, that was a fun ride. Is that where you will be? And if it's not, because I think actually there are some people that'll say that. It's one or the other. But I think there's a lot of other people that only have seen a market go straight up on these things. And even when it's gone down, it's still gone straight up and think, well, that's what it'll do. And those types of individuals should probably think about, well, what if it doesn't? Would there be a scenario where I'd be sitting in that same dust bomb and I say, well, I'm glad I pulled some profits. I'm glad I had some profits over here. That's the thought experiment that an investor policy statement will allow you to go through.
Brian, I wanted to ask you a specific question because you also mentioned in terms of, okay, you're at this point where you're approaching 10% of your portfolio in Tesla, and you talked about selling, right? And you also mentioned the word tax in there. So I'm curious how, okay, this is becoming a reality for you. How do you think about taxes? How do you think about precisely which shares to sell? So there's potential long-term capital gains, short-term capital gains. There's specific ID in terms of what shares can I sell? Talk me through your thought process, because I think there are people listening who need this precise information. How do you think through that?
Yeah, taxes always need to be considered. And that's not something that I take lightly, because I know that, well, it's wonderful to have a stock that's up huge or an asset that's up huge. What's less wonderful is paying the tax man once you come to sell that. However, I'm also a believer that in the flip side, you don't want to make decisions solely because of taxes. If I think that if Tesla became an uncomfortable position for me, I would sell and just pay the taxes, realizing that the net result of all that was a huge positive gain for me. So if a stock goes up 10x for me and I sell it and the taxes are 1.5x, well, I still made 8.5x net as a result of that. So I'll always consider the taxes, but you can't let taxes be the sole determination of what you should do. As to your point about which shares would I buy or would I sell, I would go and probably sell the ones to minimize my tax burden. So I would sell the shares that were at the highest price now. But I'm not saying that's the best strategy, because there is some impetus to saying, well, tax rates might be higher in the future, and therefore it's selling the lowest cost basis one. That's not something that I honestly think too much about. I would more be concerned with how much of my net worth is in this stock and how much do I want in this stock.
And I think the one thing that would just be probably useful for people generally as they're going through that, do I want to pick a specific ID, and do I want to base that on how much has the most capital gains or the least capital gains? One additional thing is just really understanding where those capital gains tax brackets fall and what the implications are if you sell it. Also, time window. Is this a short-term capital gains where you've held it for less than a year, or long-term capital gains? But that could be a reason, Brad, and I think you could point out the 3 different options. I think you said it briefly in passing earlier, but you could do specific ID, which is grabbing the lot. So you bought a certain number of units on a certain number a day. Those were assigned to specific ID. You could do first in, first out, or you could do just average price. And I don't know how often you get to repick that. So I'd be curious if you have any thoughts on that generally. So first in, first out is just by default likely for long-term buy and hold investors. You're going to be picking the ones with probably the most capital gains, but not necessarily, depending on the volatility. But by almost a surety, you're going to be picking ones that would be in a long-term capital gains bracket, not in a short-term capital gains. So short-term capital gains are taxed at your income, your marginal income tax rate. Long-term capital gains are going to be taxed at the capital gains tax rate, which at this time, depending on what we're talking about, up to $100,000, I believe married filing joint is at a 0% tax bracket, and then $100,000 to $400,000 is at a 15% marginal tax bracket. So those are just, you should do some more research and see how it applies to your specific situation. But, 0% is very appealing. So would you make some decisions like, could I act in this range and sell enough to not trigger anything? That's cool. And then you can make the decision around the 15% marginal tax bracket. Still not bad. Here in the United States, we have 10, 12, and then we go to 22 and 24 marginal tax rates. 15 is not too bad. So could you make some decisions, in that range that would work for your specific tax situation? All right, everyone. Well, I hope all of you have the wonderful problem of runaway winners. And I hope this conversation is valuable for you as you figure out what to do. For those of you that are interested in the checklist that we talk about and more information on Brian's upcoming book, which will be coming out in early 2022 called Why Does the Stock Market Go Up? You can access that free checklist and get all the information about the book by going to choosify.com/Brian. That's BRIAN. And I would also tell you that if you want to follow one of the most interesting and engaging personal finance Twitter accounts on Twitter, you should definitely connect and follow Brian Feroldi. Brian, where is your hashtag and what do you do on your Twitter account? How do you use your 240 characters or whatever it is?
I use them a lot. I'm very active on Twitter. I'm constantly tweeting out information about the stock market and mostly about the mindset of being an investor. So if that interests you, I'm at Brian Feroldi, BrianFeroldi.
Brian, thanks so much for coming on the show today.
Love being on.
All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.